US President Joe Biden wants US oil companies to boost oil production. But according to the Financial Times, two powerful forces are working against that call. Wall Street wants oil groups to shower billions in profits on investors rather than spend freely on new supply. The International Energy Agency has warned that oil demand will peak by the middle of next decade, undercutting the case for massive new investment. These tensions were on display in the past week as Exxon and Chevron reported net profits that over the past 2 quarters added up to the biggest in their histories. The two US oil supermajors said they would funnel cash towards shareholders in the form of higher dividends and share buybacks. They did not say they would spend more to raise production. And Goldman Sachs has argued that this will lead to a long period of oil prices above $100 a barrel. As of the 2nd of November 2022, WTI, that is West Texas Intermediate Crude, settled at $90 a barrel. On Monday, the 31st of October, Joe Biden accused oil companies of war profiteering and threatened them with new taxes if they did not accelerate output. He thinks they have a responsibility to act in the interest of their consumers, their community, and their country to invest in America by increasing production and refining capacity. But investments by supermajors, which remain more committed to their core oil and gas businesses than their European rivals, are down about 30% compared with their plans before the pandemic. Exxon in 2019 said it planned to spend $30 to $35 billion a year on its business, but has now cut it down to $23 billion a year. Chevron had signaled annual capital expenditure of about $19 billion to $22 billion before the pandemic, but it envisages only $15 billion to $17 billion. Both companies will update spending plans in December of this year, 2022, but neither said they plan to raise medium-term targets when asked by the Financial Times. So Chevron aims to raise oil and gas production 3% a year, and ExxonMobil about 2% a year, coming largely from investments made years ago. Pavel Molchanov, an analyst at Raymond James, said that oil companies could still drill more, but they do not want to because their shareholders had pushed them to invest less and instead pay more dividends and share buybacks. And their shares, in many cases, are at all-time highs. ExxonMobil shares have climbed 79% this year, even as the S&P 500 index has fallen 21%. So Chevron is up 52% in 2022. The signals from our investors don't suggest they want to see more investment in production, according to Chief Executive of Chevron, Michael Worth. This was what he said last month, in October, 2022. Darren Woods, Exxon's chief executive, last week defended the company's heavy spending on dividends at a time of high fuel prices for consumers. There has been discussion in the US about our industry returning some of our profits directly to the American people. In fact, that's exactly what we are doing in the form of our quarterly dividend, he told investors after Exxon reported quarterly net profit of $19.7 billion. Independent US shale producers, which over the past decade delivered much of the world's oil supply growth, are also holding spending steady. Scott Sheffield, chief executive of Pioneer Natural Resources, last week told analysts that his company's low reinvestment rate would moderate oil production growth, but generate free cash flow that would be paid out to shareholders. Just days before the industry's latest bumper profits, the IEA said that for the first time it saw definitive signs that oil demand would peak under the current government policies. It said crude demand would probably grow at less than 1% a year before peaking in 2035, although it still forecast that demand will remain elevated to 2050. Worth, the chief executive of Chevron, and other oil executives said investors do not want them to invest, in part because of policies and rhetoric in the US and Europe aimed at shifting the economy away from fossil fuels to fight climate change. So despite the slowdown in expected consumption, the IEA said the industry would still need to plow about $470 billion a year into oil and gas production projects this decade to keep up with the demand, about 50% more than in recent years. So Supermajors brush off Biden's plea for output rise. Capital spending targets at ExxonMobil and Chevron are well below their pre-pandemic plan. So see what you make of all of these things. And in a previous video, we pointed out that by next year, 2023, there's a good chance that oil will reach what may reach $150. That was even in part because China might begin to open up and the demand may begin to rise. Because right now the price is somewhat subdued because of the colder weather and the lockdown that is in place in China and indeed some parts of Asia. Indeed, when China is locked down, the world is equally locked down. So come the spring of next year, 2023, they might be opening up and demand might also peak. So if you add what's going on already, because what we just read out now doesn't really include what's going on in China, even though, remotely there's also partly involved, rather partly responsible for the rise in the elevated price we're talking about. We're talking about $90 as of late, as of the time we're recording this video for the WTI. So given that China might begin to open up come the spring of next year, 2023, yeah, there's a good chance oil might get to $150. So see what you make of all of these things, and thank you very much for watching this video.